Hello and a very warm welcome to Policy Watch, our weekly program that seeks to keep you abreast of all the major economic developments of the week. This week we start with a mid-quarter review of the monetary policy by the new Reserve Bank of India Governor. We then move on to the surprise move by the US Federal Reserve to defer its tapering, and last of all to the austerity measures announced by the government to get fiscal deficit under control. And to discuss these stories with us is Renu Kohli, economist and former IMF and RBI staffer. Welcome to the show, Renu.
Thank you.
Yesterday's poster boy, Raghuram Rajan, has fallen from favour. His 25 basis point hike in the repo rate from 7.25% to 7.5% hasn't been taken kindly by the market. Of course, the government has already said he's not going to be bothered about Facebook likes, but his action has earned him too many dislikes. Is that possible? We'll first ask Renu about this, but before that, a bureau report.
With an eye on firmly tackling inflation, new Governor Raghuram Rajan surprised the markets with his very first policy announcement on Friday. Rajan increased the short-term lending rate from 7.25% to 7.5%, continuing his predecessor D. Subbarao's policy.
You can't do it alone while not paying heed to the fact that inflation has been on an uprise. Partly also there are inflationary pressures because of the rupee depreciation.
But in order to increase the money supply, Reserve Bank cut the marginal standing facility rate, the rate at which banks borrow from the central bank, by 75 basis points from 10.25% to 9.5%. The RBI also maintained cash reserve ratio, a portion of deposits that banks need to maintain with them, at 4%. It also reduced minimum daily maintenance requirement of CRR from 99 to 95% to improve money supply.
Given that market conditions have been very favorable in the last couple of weeks leading up to the policy, we felt increasingly confident we could withdraw those measures and thereby, and this is an emphasis that the market is not picking up, reduce the cost of funding to the financial sector. Now you may say short term, long term, the point is immediately there will be a reduction in the cost of funding to the financial sector.
Not surprisingly, stock markets reacted sharply to the rate hike. BSE Sensex tanked by nearly 500 points immediately after the announcement, but recovered marginally in afternoon trade. Both BSE and NSE were down nearly 2% at the close of trade. Rupee also depreciated by 62 paisa against the US dollar. Krishna Tripathi report, Rajya Sabha TV.
Well, Renu, were you surprised? What was your initial reaction? Did you really expect the repo rate hike at all?
No, I must confess that I was surprised as well, and I thought that the Reserve Bank would stay the course. I did expect, following the US Fed's decision yesterday, that the central bank would start rolling back the measures in a calibrated manner, which has played out exactly as I expected. Of course, there could be a bit of expectations about the MSF rate cut, etc. I did not expect actually such a deep cut, 75 BPS, but then it was hiked rather sharply more than a month ago. So I was a bit surprised at that. Clearly, he has signaled through this that he will be proactive on inflation, A. B, he will also be forward-looking and move ahead of inflation, and the central bank's reading or interpretation of the pass-through effects of the depreciation clearly are little above what they had targeted, what they had projected for the year. So given in that light, I guess it is the right time. I think the timing is right because they had already tightened so much, and from there is going to be a reduction. So in the sense that if they, from the top end at the short twisted yield curve, if they're moving towards normalization, this was perhaps the right time for them.
Except that the governor in his press conference subsequently after the statement said that actually since he's eased up on the marginal standing facility, net it should lower the cost of funds. At the same time, he's hiked the repo rate. So what would you agree with it? At net, would you look at it as more a tightening than an easing?
Well, I would say that the signal is very much tightening, simply because the policy rate is the repo rate, and the MSF rate hike was viewed essentially as temporary or emergency measures.
Absolutely, particularly because the name marginal standing facility already means marginal. It cannot be the base rate, really.
So what I can see is that ahead, the central bank used this opportunity to move a bit more on the upside and guiding the market towards generally an upward structure along the yield curve. That's what they are doing. At the same time, he guided the market's attention towards the fact that they were actually lowering so as to not dampen sentiment too much. And that's what he is doing. In fact, in his post-policy conference, he clearly stated that he would expect his stance to be interpreted as neutral. And he's made it data contingent.
Well, markets clearly weren't buying that because the way they tanked, of course, they recovered subsequently. And he has always said, but do you think the RBI stance in terms of tightening, as we both agree that it's more or less, it's more tightening than loosening. Do you think he's been helped by the fact that the government also is now getting concerned about inflation? Because with elections coming up, every government knows at the end of the day, if they want to win at the hustings, you have to keep inflation under control. So has that helped him in some way?
I wouldn't say that, because there are contrary signals on inflation. If you look at WPI and in particular the core measure, that's actually come down very significantly, despite the fact that the headline rate went up. And therefore, on the demand side, demand is very, very weak, and that was a very strong argument in favor of staying keeping the policy rate unchanged. On the other hand, if you look at the CPI, it's been going up, but then we have to actually at the end of the day say, where is it coming from, the drivers? And if the drivers were a seasonal spike in vegetables, then I really see no role for monetary policy. But in a sense, the Governor Rajan had already committed himself when he took over on the very first day. He did say that the core mandate of the central bank is price stability, and whatever be the source of inflation, whether supply, demand, or from changes in the value of the currency. So, given that and against that backdrop, it is probably the reading is that the depreciation pass-through will push up inflation. Absolutely. Along with that, they are also having fuel price increases. There might be another one, a diesel one.
And you also have the likelihood of dollars coming in because of the offer of the swap window.
Yes.
So that will also add to easing of liquidity. So clearly, I think inflation has come to the forefront of the RBI's stance between growth and inflation. Though, of course, he said that, yes, we're concerned about both. But would you think that if at all, it's not exactly even, but inflation has come slightly to the front burner and growth has taken the back seat? A little bit at least?
In terms of signaling towards a more greater accommodation in the near term, yes, I would say that inflation is a little more concerning dominating the central bank's response function vis-a-vis growth. But that is not to say that the growth isn't important. What I understood was that there's a very clear communication from the RBI that this breather that has been provided by the Federal Reserve for a few months is going to be used to continue the ongoing correction in the macroeconomic imbalances. And from that point of view, it is a very, very confidence boosting signal to all concerned, both domestic as well as foreign investors. The reason why I say the domestic investors is because he has said it very clearly that the exchange rate, given the fact that the capital account shocks reversal and those threats have by and large subsided temporarily, it's the internal value of the currency.
Absolutely, and because he keeps talking about the internal value, and he said if you preserve that, the external value automatically gets protected.
Absolutely.
But he also used a word, Renu. He said we need to use this time to bulletproof our national balance sheet. How can one bulletproof, and is that in the government's court, not in the Reserve Bank of India's court?
No, I disagree with that slightly, because of course the national balance sheet has two aspects. There's the savings investment balance, and we all know that there is government is saving, but we also know that on the right hand, on the right side, the variable on investment is not. It's basically gold. A lot of it is gold, the savings, and I disagree with the notion that the savings into gold, migration of savings into gold from deposits, cash, etc., is an outcome of purely fiscal expansion. There have been monetary policy responses in the past which have been extremely loose, and it took time to catch up, and there were indicators that demand was very strong, GDP growth was very high, and yet we had the savings rate falling.
So this was a welcome correction. So at last,
I think
savers
that
are going
is a
to get
very
some
good correction,
positive
and
rate of interest.
at last, even as far as the fundamental value of the exchange rate is concerned, I'm very happy to see that the fact that fundamentals have at last entered the exchange rate considerations.
Absolutely, because actually if you see, India is a bit of a laggard. All other emerging markets had actually raised their rate of interest much earlier and much more sharply. At the same time, there was one significant omission. While saying that the WPI, the wholesale price index, would be higher, the governor did not commit himself to any number. If you remember, the RBI had said it will be about 5%, which the Prime Minister's Economic Advisory Council recently raised to 5.5. But the RBI has been completely silent. Now, when you say WPI is going to be higher, how much higher? Is that silence a plus or a minus when it comes from the central bank?
I think this was just a press release statement, and typically when they raise their inflation projections, at least in the past, they haven't really used this inter-quarter review to communicate such a thing. I would expect that the next review after 6 weeks, the mid-quarter review, the mid-year review, will probably have some kind of idea. We will also have another two data points. One will be on the WPI and the other on the CPI. So probably if they have to raise their projections at the end year, they might
for future projections and WPI as
so.
well as growth for the mid-year review. But we'll be back very soon. Please stay with us. Welcome back. After weeks, if not months of talk of Federal Reserve tapering, a term that refers to the US Federal Reserve reducing its bond purchase, read basically pumping in money, from the present $85 billion a month, the FOMC, the policy making committee that was expected to announce a schedule of tapering at its meeting earlier this week, decided to defer its decision for now. The news, which was mostly unexpected, immediately acted as a fresh boost to forex and stock markets in emerging markets. The rupee rallied to touch a high of 61.7 to the dollar, even as the Sensex ended 684 points higher immediately the next day. In the very short term, this may be good news, but how can we prevent a repeat of the mayhem that we saw earlier this year when the Fed had talked about tapering? We'll ask Renu about that, but first, this Bureau report.
The US Federal Bank surprising markets worldwide, continuing its stimulus of buying bonds at the current rate of $85 billion per month. It justified the move, stating that tightening of financial conditions could slow the improvement in the economy.
There is no fixed calendar schedule. I really have to emphasize that. If the data confirm our basic outlook, if we gain more confidence in that outlook and we believe that the three-part test that I mentioned is indeed coming to pass, then we could move later this year. We could begin later this year, but even if we do that, the subsequent steps will be dependent on continued progress in the economy.
US markets rose sharply after the announcement. The S&P 500 hit a record high, while US bond prices and gold prices also shot up. The Fed, however, lowered its forecast for GDP growth in 2013 to 2% to 2.3% against its earlier estimate of 2.3% to 2.6%, due to what it called strains in the economy from a tight fiscal policy and high mortgage rates asset purchase program at current pace. In the official statement, the central bank made it clear that it was still considering the right time to roll back its bond buying stimulus. In June, the bank had stated that it would reduce and even end its bond buying program by mid-2014, when the US unemployment would be around 7%. It's now saying that the figure is not a magic number.
The unemployment rate is not necessarily a great measure in all circumstances of the state of the labor market overall. For example, just last month, the decline in the unemployment rate came about more than entirely because of declining participation, not because of increased jobs. So what we will be looking at is the overall labor market situation, including the unemployment rate, but including other factors as well. But in particular, there is not any magic number that we are shooting for. We're looking for overall improvement in the labor market.
The US Central Bank has maintained a near zero interest rate regime since the economic crisis of 2008. Its bond buying program has swelled its balance sheet to a record $3.6 billion and has kept the interest rates low. It has reiterated that it would not start to raise rates at least until unemployment falls to 6.5%. Bureau Report, Rajya Sabha TV.
Renu, when you compare the action of the US Federal Reserve with that of the Reserve Bank of India, would you think that the Federal Reserve has chickened out when it really came to tapering, and the Indian central bank has, on the contrary, stood firm and administered stiff medicine because it was needed right now?
Yeah, the comparison is, it's rather a contrast, but then the wisdom guiding the Federal Reserve and the wisdom guiding the central bank are, the Reserve Bank are two different things. In the case of India, it has been hit. Of course, the trigger was the Fed Reserve's suggestion that it might taper towards the end of the year, later this year, and therefore it has been through a huge depreciation shock. And in the face of that shock, some of the old problems have returned, like inflation, and some of the problems have got magnified and it became evident that they could no longer be not attended to, or they could no longer be ignored. So the decision of the Reserve Bank is taken against that backdrop, and it has decided to continue to mend the balance sheet, both on the external balance sheet as well as the internal balances, which were long overdue for correction. On the part of the Federal Reserve, I think, as they stated, that there were two things that have actually guided their thing. One is that the financial conditions tightened enormously, and given the fact that the central bank's, the Fed Reserve's presence in the bond market is so huge, it's like an elephant, because there's about 3 trillion of purchases that has been accumulated on the Fed's balance sheet up till now. So to return and retreat from that was frankly pushed up yields.
Except that basically what you're saying is that each central bank very rightly looks at its own domestic constituency. But the fact is that the US Federal Reserve basically has become the de facto central bank for the whole wide world, because their policy impacts the whole world, but they're looking at the consequences only at their own domestic economy. How can the rest of the world correct that and make the US Fed behave a little bit more responsibly, quote unquote?
I doubt if the rest of the world, particularly emerging markets, which were actually the ones which were the worst hit. Otherwise, India was actually on its way to recovering a bit.
Absolutely.
And all the indicators were turning up, albeit slightly. I doubt if any or even if all the countries of the world gathered together, 185 countries of the IMF, and they cannot pin any sovereign issuer to have international consideration into
So the G20
its.
is of no use at all, you're saying?
Well, I would say that I wouldn't say that it's useless, but I would say that central banks do have a domestic mandate, which is something which the PM acknowledged at in his address at St. Petersburg summit. So they have to follow that. The issue is slightly different. What the G20 must learn again repeatedly from this shock is that the fact is that you cannot have a currency which is a national currency, and it's also the world's global reserve currency.
Yes.
And that's where the G20 has to, or rather the emerging nations and developing countries, they have to mount pressure that is significant enough to
reform
move
the
towards.
IMF. But how do we get there? How do we get IMF to get reformed when the US has a veto power? They have 17% of the votes, and that gives them a veto power. So how do you get them to shoot themselves in their foot?
Well, I think there is one way. They can strengthen China in having yet another currency in as
well, Renu, we live in that hope.
Currency.
I hope you succeed, and I hope your wishes come true. But with that, we'll take a very short break, but we'll be back very soon. Welcome back. We move into our last story for this week. Faced with a very real possibility that the government might not be able to adhere to its promise to stick to its fiscal deficit target of 4.8% of the GDP, it has announced an austerity package that includes a number of measures like no more travel in executive class for senior bureaucrats, no more conferences in 5-star hotels, etc. But given the numbers that we're talking about, we're talking, mind you, a fiscal deficit of 5,42,000 crore. Does a saving of about roughly 10,000 crores or so really make a difference? Let's ask Renu about that. But first, this Bureau report.
The government is pulling out all stops to contain the fiscal deficit. On Wednesday, the Finance Ministry issued a circular listing austerity measures to cut non-plan expenditure by as much as 10%. It's putting a freeze on fresh government appointments, banning five-star hotel conferences, buying new vehicles for government departments and also executive class air travel for officials. The ministry also wants the size of delegations going abroad to be kept at an absolute minimum.
एक संवेदनशील सरकार होने के नाते यह हमारा उत्तरदायित्व बनता है, जिम्मेवारी बनती है कि जो जनता का पैसा है, जो करदाता का पैसा है, उसको एक बहुत ही सटीक तरीके से खर्चा जाए.
Faced with slow economic growth and weak tax collections, the government said it had few options to ensure fiscal discipline without hurting operational efficiency. The steps are intended to keep the deficit within the 4.8% red line that Finance Minister P. Chidambaram has drawn. Similar measures helped the government to contain the fiscal deficit at 4.9% of the GDP in the previous financial year against the budgeted target of 5.1%. Bureau Report, Rajya Sabha Television.
Renu, how sincere do you think the government is in its austerity measures? Because on the one hand, we hear them talking austerity. On the other hand, we just heard reports that the senior IAS officials, etc., can take their families abroad for medical treatment. We've also seen the government just raise the DA compensation to 90% from 80%. So what are we talking about? Is the government really serious, or are these just noises that they're making for public consumption?
Well, I think it's these austerity measures that have been announced are precisely that, to offset the expansion on one side of the budgetary balance, which is with a contraction on the other aspect. By in itself, the estimated impact on the overall fiscal gap is estimated between 0.3 to 0.5 percentage points of these reductions. But at the same time, I think it has a signaling effect, which is to communicate fiscal intentions are in a certain direction. And even though there might be a food security law or there might be some kind of extension, and I would just like to say that the raising the allowances or the medical allowances for the IS officers may not kick in this year. So that's something in the future. Probably it's not budgeted for, so it doesn't impact the fiscal deficit at this point. Though of course I realize that it is, I acknowledge that it is on an expansionary trail. So the idea is to communicate fiscal intentions and signal and send across a signal of credibility, which
except that if the government wished to be consistent, you'd expect these austerity packages to be accompanied by a rise in investment and not in other spending, because after all, when you spend things like DA compensation, things like increased allowances for senior staff, etc., that is not going to get you any bang for the buck. So if the government were to use this money which it saved on consumption for some investment purposes, you might see growth at least get some benefit. So what is the government doing? Is it being very inconsistent in its approach?
I would put it slightly differently, that in principle what you're saying is yes, of course, when fiscal consolidation takes place, the axe should fall upon current expenditure rather than capital expenditure, because that is good expenditure and the current is not always good. But saying that, all over the world you will observe that when there are cuts, because fiscal reforms tend to be politically costly, and there are rigidities which are built in on the current expenditure side. And let's go through the items on the current expenditure. These are wages, interest expenses, salaries and so on. So these are things, and subsidies of course. These are things that cannot be, they are relatively inelastic. You can't touch wages and salaries, except in the case, it would be as bad as Greece was, for example. But yes, subsidies can be contained and they can be limited, which is in part we can see this playing out. It's a gradual process, and I would say that the gradualism is required, because the political fallout of it can be quite hurtful if you have an entire generation or entire segment of the population which has been encouraged and nurtured upon a culture of subsidies, which is the case with the fuel subsidies. And
we've already reached 62% of the fiscal deficit for the entire year, so we don't have too much time. But on that note, Renu, I think we come to the end of this program. It's been great having you. But before we end the program, look at the key takeaways. As far as the Raghuram Rajan's first maiden mid-quarter review of the Reserve Bank of India's monetary policy for this year is concerned, Renu was willing to say that this is the right move, even though it is tough medicine at the moment. He has given some kind of sops by ease of the marginal standing facility rate, so that is some kind of sop, but long term we did require the correction in the repo rate. Inflation is a big problem and we do need to address it. On the second issue of the Fed action, well, both she and I are in complete agreement that as long as the US dollar continues to be the international reserve currency, all of us will have to be takers for whatever the Fed decides, and that's not a very good news either at all. And on the last story about austerity measures of the government, I'm afraid Renu was much more charitable towards the government than I'm prepared to be. She felt that yes, the government is making its efforts to contain the fiscal deficit and we must give it credit where it's due. With that, we come to the end of this program. Thank you so much for being with us, but we'll be back next week, same time. Till then, it's goodbye from all of us at RSTV.